Fairly straightforward first question. We saw obviously a massive rout Friday in credit and in equity. We're seeing a timid bounce back today. What do you make of the price action?
Well, I think the price action makes sense given the circumstances, but unfortunately, Sam was quite right. We just don't know how the Omicron variant is going to evolve. And we really just don't know what sort of impact this is going to have on markets going forward and indeed on economies going forward. So it adds uncertainty to what was already a blurry outlook. That being said, we have, of course, seen that buy the dip mentality coming in already. December is usually a very strong month for US equities. We know corporate buybacks are accelerating into year end. So outside Omicron, there were reasons to be bullish equities moving into year end, but this does provide that layer of uncertainty for sure.
So does that mean buy the dip, but with a lot of extra hedges?
I think so. In terms of high conviction views, it's difficult to have them right across markets at the moment. What I do have is that I certainly think the US dollar is going to head higher. I certainly think we're going to see higher volatility in interest rate markets. And when it comes to equity markets, look, the mega tech companies have done a very good job of holding up those headlines. The action has and will continue to be below the surface, the rotations into and out of value. I tend to think that at this stage, until we do get more information on Omicron, a slightly cautious approach is warranted. That being said, within the value space, I like financials, I like selective energy, but I'd probably be careful of travel stocks at the moment.
Yeah, I think you're probably not alone in that. Christian, talking of the cautious response, do you think we get a cautious response from central banks as a result of this? What I'm trying to work out at the moment is what impact this will have on Fed policy, Bank of England policy, ECB policy. There is a danger that if it turns out to be a difficult variant to deal with, that we end up seeing an impact on the labour market as we see lockdowns or lockdown lights being reimposed. But if that's the case, then we're likely to see also higher inflation. On which way do you think the Fed and other central banks how will they deal with that?
Well, I think central banks in most developed countries are really stuck between a rock and a hard place, and that counts for the Fed as well. We've seen massive repricings of the front end. I think we continue to see that as we get to grips with the strength of this recovery. And the labour market is a key part of that. There's a lot of focus on the unemployment rate, but of course the participation rate has fallen a lot as well. And that hasn't surged back higher. And we don't know how many people have left the workforce for good and how many will be forced to return to the workforce earlier next year. I tend to be of the view that the wage growth we've seen this year has been more about distortions and that it's less likely to continue as we move into next year, particularly as we see some more Americans forced back into the labour force. But when it comes to the Fed, I tend to think they're going to be pretty cautious. I don't even buy the idea that they'll necessarily raise rates twice next year. I think we may well only get one rate hike next year. And as for the tapering process, well, I tend to think that they're going to stick with the pace that they've already outlined rather than stepping that up at the December 15th meeting.
Yeah, and Goldman, though, before Omicron came out, increased their forecast for rate hikes, three starting in June for 2022. So, Christian, what was really interesting is that before all of this, the idea that we were going to get a rotation into value cyclicals and small caps was kind of permeating in the market. Whether or not that was coming true is a different story. Does that push this out altogether, and then you have to go by the safety and the growth of the big tech? Or can you start to play with that rotation?
Well, I certainly like the mega tech companies at the moment. You know, they have been a stronghold, and I think they'll continue to be. When we talk about value, I think it's more about being selective. You know, investors that can be agile in this environment, they're the ones that are going to be outperforming. And it is back to that old-fashioned environment of stock picking to an extent as well, I think, if you're going to weather this storm. But of course, you know, Fed actions will remain key. If they do step up the pace of tapering, then I think that will take the wind out of a lot of the growth stocks. But as I said, that's not really my base case. I think the one thing that central banks are going to want to avoid is a policy mistake. You know, look at the ECB back in 2011. They've never been able to raise rates since. And the last thing the Fed wants to do is raise rates and then be forced to unwind that. So I think the middle of next year, even that is too early to really start to put the pressure on rates from central banks and for the Fed in particular.